The dramatic pride dip in Centene stock. Opportunities and risks. Centene Corporation, a major player in the managed healthcare industry, has experienced a severe and rapid decline in its stock price, particularly since July 1st, 2025. The stock has fallen to levels around its 52-week low of approximately $32.20 to $32.52 as of July 10, 2025, representing a drop of over 40% in just over a week and a year-to-date decline of around 43%. This sharp downturn is a direct consequence of a series of unexpected and concerning announcements made by Centene, primarily impacting its government-sponsored healthcare programs. Key drivers of the dip. Centene's unexpected challenges. The core of Centene's recent stock collapse stems from critical revelations about its financial outlook and operational performance, significantly affecting its Affordable Care Act marketplace in Medicaid segments. Abrupt withdrawal of 2025 financial guidance and massive earnings. Cut on July 1st, 2025, Centene made the highly unusual and alarming decision to withdraw its full-year 2025 GAAP and adjusted diluted earnings per share guidance. This move immediately signaled profound uncertainty and a significant deterioration in the company's projected financial health. The company revealed a preliminary estimated $1.8 billion reduction in its full-year net risk adjustment revenue transfer for 2025. This directly translates to an adjusted earnings per share impact of approximately $2.75 per share. Considering Centene had previously guided for adjusted earnings per share of over $7.25 per share for 2025, this represents a massive cut, effectively lowering the revised estimated earnings per share to around $4.50. This initial estimate was based on data from 22 of Centene's 29 marketplace states, approximately 72% of its marketplace membership. Centene explicitly stated that it anticipates additional reductions from the remaining 7 marketplace states due to observed morbidity trends, suggesting the total financial hit could be even greater. Deteriorating performance in key markets. The most significant factor cited was new data from Wakely, an independent actuarial firm. This data showed that the health risk profile of new and existing members in its ACA marketplace plans was significantly higher than, and materially inconsistent with, the company's prior assumptions. In essence, Centene is insuring a much sicker group of individuals than it expected, leading to substantially higher medical costs per member. This higher-than-expected morbidity directly impacts the Federal Risk Adjustment Program. This program helps balance financial risk among insurers. Centene's adverse shift in its risk pool means it will receive significantly less in these crucial transfers, directly impacting its profitability. Concurrently, Centene reported a step-up in medical cost trends within its Medicaid business. This was particularly noticeable in areas like behavioral health, home health, and high-cost prescription drugs, especially in states such as New York and Florida. This is expected to result in a higher Medicaid health benefits ratio for the second quarter of 2025 compared to the first quarter of 2025, indicating deteriorating profitability. The company also noted slower than expected overall market growth in its ACA marketplace states, compounding the financial pressure. Intense market reaction. On July 2, 2025, following the guidance withdrawal, Centene's stock plummeted by nearly 40% in a single day, wiping out over $11 billion in shareholder value. It reached its lowest levels since 2017. The unexpected news triggered a rapid wave of downgrades and price target cuts from major Wall Street analysts, including UBS, JP Morgan, Barclays, Bank of America, and Morgan Stanley, which cut its target from $70 to $33. Several prominent law firms have announced investigations and filed class action lawsuits against Centene Corporation. These lawsuits allege that the company and its executives may have violated federal securities laws by misleading investors about its financial health and projections. While Centene's issues are primarily company-specific, its problems have sent ripples through the broader health insurance sector, causing shares of competitors like Molina Healthcare and Elements Health to also experience declines. Opportunities for investors. Despite the severe price dip, some investors might see this as a potential buying opportunity due to the following factors. The stock is currently trading at historical lows and appears significantly undervalued based on traditional metrics, such as its forward price-to-earnings ratio of around 4.8 times trailing earnings per share. This dramatic sell-off could be a capitulation event, potentially pushing the stock below its intrinsic value. If the company can demonstrate a clear path to recovery, there could be significant upside. Morningstar, for instance, still sees the shares as moderately undervalued for the risks. Centene remains a dominant player in the Medicaid and ACA marketplace segments. While these markets present challenges, they also represent a large, stable, and growing portion of the U.S. healthcare landscape. Its deep expertise and established relationships with state governments give it a competitive advantage in navigating complex regulatory environments. Centene has stated it is actively engaged in repricing its 2026 marketplace rates to reflect the higher projected morbidity. The ability to take corrective pricing actions in a substantial majority of its marketplace membership could help stabilize profitability in the medium term. Successful repricing could significantly improve future earnings outlooks and rebuild investor confidence. On a more positive note, Centene indicated that its Medicare Advantage and Medicare prescription drug plan businesses are performing better than expected in the second quarter of 2025. These segments could provide some offset to the challenges faced in ACA and Medicaid. Despite short-term volatility, the long-term trends of an aging population and continued demand for government-sponsored healthcare programs remain strong. Centene is well-positioned to benefit from these secular trends, provided it can manage its costs and risk effectively. Risks for investors investing in Centene at this juncture carry significant risks, which account for the recent dip. The withdrawal of 2025 guidance creates massive uncertainty. The initial $2.75 earnings per share hit might not be the full extent of the problem, as data from all states and future cost trends could lead to further revisions. Analysts have already begun to lower 2026 earnings estimates, indicating a potential longer-term impact. The rising medical cost trends in Medicaid and the higher morbidity in ACA marketplace are fundamental challenges. If Centene cannot effectively manage these costs or negotiate favorable rates, profitability will continue to suffer. The stickiness of these trends is a major concern. Government-sponsored programs are highly susceptible to policy changes. Congress passing budget reconciliation bills or other regulatory shifts could further impact funding for Medicaid and ACA, directly affecting Centene's revenue and profitability. The potential for increased scrutiny from regulators due to the risk adjustment issues could also pose a threat. The health insurance market is competitive. While Centene is large, other players are also vying for market share and adapting to the changing risk landscape. The death spiral scenario, where higher premiums due to sicker enrollees lead healthier people to exit the market, further exacerbating the risk pool, is a theoretical but present danger in the ACA marketplace. The numerous class action lawsuits alleging misleading guidance create legal and reputational risks. Legal battles can be costly and divert management's attention. A potential downgrade of its credit ratings to junk status would increase its borrowing costs and reduce financial flexibility. Centene has grown significantly through acquisitions. Integrating these acquisitions and maintaining operational efficiency while addressing cost challenges is a continuous task that adds complexity. Outlook. The immediate outlook for Centene is highly uncertain and challenging. The period until the second quarter 2025 earnings report on July 25, 2025 will be critical. Investors will be scrutinizing the details of cost trends, updates on the remaining marketplace states, and a clearer articulation of the company's strategy to reprice 2026 plans and manage its risk profile. In the short term, expect continued volatility. Any further negative surprises or indications that the cost trends are worsening could lead to more downside. The stock is likely to remain under pressure until there is clear evidence of stabilization and a credible path to sustained profitability. For the medium term, covering 2026 to 2027, the success of Centene's 2026 repricing efforts will be paramount. If they can effectively adjust premiums to cover higher medical costs and improve their risk adjustment calculations, there's a potential for earnings to stabilize and rebound. However, this process will take time, and there's no guarantee of full recovery to prior profitability levels. The legal proceedings will also continue to be a factor. Long-term Centene's outlook depends on its ability to adapt to the evolving government healthcare landscape. Its core business of serving underserved populations in Medicaid and ACA remains a significant addressable market. If management can prove its ability to effectively manage risk and costs in these complex segments, the current dip could eventually be seen as a temporary setback for a company with a strong long-term position. However, investor confidence has been severely shaken, and rebuilding it will require consistent positive execution over several quarters. In essence, for risk-tolerant investors, the Pride dip presents a highly speculative opportunity based on the premise that the market has overreacted and that Centene can successfully navigate its current challenges. For most, a wait-and-see approach for more clarity on Q2 earnings and future guidance would be prudent.